Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. We had more than a half dozen Fed officials addressing the issue of rate cuts today. One of them, the head of the Minneapolis Fed, Neel Kashkari. Curiously, he was saying rate cuts may not be needed this year, especially if the economy remains robust.
If we continue to see strong job growth, if we continue to see strong consumer spending and strong GDP growth, then that raises a question in my mind. Well, why would we cut rates? Maybe the dynamics that we have right now are actually sustainable. But there are a lot of ifs underlying that question and that hypothesis.
He is Neel Kashkari, the head of the Minneapolis Fed, at a virtual event on LinkedIn earlier today. We also heard from the head of the Cleveland Fed, Loretta Mesters. She suggested the Fed could be getting close to the level of confidence it needs to begin cutting. And Austin Goolsbee, the head of the Chicago Fed, was saying today those higher than expected inflation readings in the months of January and February likely don't change the broader picture of cooling price growth. Let's get to our guest. George Boubouras is with us. George is Managing Director of Research and Investments, also advisory at K2 Asset Management. He joins us from the line in Melbourne. George, thanks for being with us. Where are we right now in the inflation story?
That's the good question to lead with, but in the Western world, inflation is falling in a non-linear manner. Others are calling it bumpy. That is pretty much as expected for most participants in the market, but some do act surprised. But that stubborn core services inflation is an issue, and then it splits very quickly depending on what narrative you are. You can look at core CPI. It is upper end of that 3 handle, or you can look at core PCE, and it's upper end of the 2 handle. The direction's in the right way. It is non-linear. It is messy. There is stubbornness to it, which is predicated on the resilience of aggregate data in North America.
Are we underestimating the effect that the crude oil market could be having on inflation? I mean, we were trading above $87 a barrel in WTI, and Brent right now is above $91. If this is lasting, if this is durable in terms of the price moves in oil, could we be underestimating where we are in the inflation story?
Just like higher interest rates are less sensitive at this stage of the cycle in broader terms of the US economy, you'd have to say higher energy prices are as well, to a degree, at this stage of the cycle versus previous cycles, decades past. But the thing to reinforce here is that the demand destruction kicks in. Rule of thumb, econometricians like telling us 90 days of these sort of prices, demand destruction kicks in. 180 days, demand destruction amplifies itself if they were to be sustainably higher. And you need GDP and aggregate data to justify it. Just like high nominal bond yields, you can tolerate it if the economic growth in nominal terms is expanding. So it comes back to it is a headwind, it is demand destruction, it is a tax on the consumer. But taking a step back is that there's a resilience for the US economy and the employment's there. So in the US, you'll be filling up at a higher price, you'd be upset with hurt feelings, but in the main, generally, that economic activity is more robust to tolerate it.
Yeah, hurt feelings in an election year. I mean, we'll see where that gets us, right? So let's talk a little bit about higher for longer in the States. Are you in the camp that we're going to get as many as 3 rate cuts this year in the U.S.?
Not so much 3. I believe they'll start 1 late in the year. But that's irrelevant. It's more, what does the data do? So having obviously Fed governors speaking about no rate cuts this year really gets the attention on the headlines, so people can sit back and go, oh, what am I dealing with here? Because it can't be as binary as rate cut good, rate staying the same bad for risk assets. It's got to be more nuanced to that. And that's what I think is happening, and people need to focus on it. So the economic data and the wealth effects for households in North America and their residential homes are much higher than what it was before. There's a double wealth effect in there. Yes, there's the fixed loans, and it's an asset in itself that has to be reset sometime. But why would someone's looking for price stability across an economy, why would you be cutting into that? So the data has to deteriorate in a faster momentum and pace, not just 1 month. It can't be just payrolls tonight. It needs to be weakness over 3 months, rolling 3 months, to be able to build that narrative of 3 rate cuts this year. But as it stands at the moment, earnings are growing. They're probably priced in to be too high single digits, but they are growing. It's quite healthy relative to expectations. And cutting interest rates in the face of these risks, and average hourly earnings is what we'd be all looking for, doesn't seem to make much sense to me.
So let's change gears, talk a little bit about China. And I'm curious as to whether or not, first, you think the economy has bottomed. And if we are in that process right now, could we begin to inflate a little bit and kind of emerge from this deflationary trap in China?
Possible. Many moving parts, and your show discusses it all the time. It's very clear that household and business sentiment in China is at real depressed levels, unlike North America, and they got deflation unlike North America. So there are many moving parts as they've got to deal with the consequences of the biggest construction housing collapse we've ever seen. But it's very clear Beijing is very targeted. So the middle class is going to maintain this painful period for a considerable time as they deviate their policies accordingly, as pragmatic as Beijing always tries to be. So there is a aggregate turnaround of data. Sentiment is very, very low in there. And they are controlling, and the rest, this is why everybody's underweight autos in the West, they are controlling the next phase of EVs and the price discovery. So Janet Yellen needs to do her best work, and even that won't be enough on the current tour, because they are ready to unload lower cost products right across the board to the whole world, and that is good for China in itself. But from the investment point of view, this is the crux of it all. We are not putting finite capital into China for the last 3 years. We are buying earnings of those exporters to China, hence the energy overweight.
Yeah, it seems as though authorities in China are really caught between a rock and a hard place. I mean, I understand the weakness in the property market and how industrial policy as a driver of growth may be able to make up for some of that. But if you're dealing with overcapacity in so many industries, it's not clear to me how you can continue to use industrial policy as a driver.
No, spot on. There's sometimes some people would say there's some cognitive dissonance with some of the policy coming out of Beijing, but in reality, they're taking a step back for the grander play, the long term. They will unload cheaper products to the rest of the world that will allow it, and North America will maintain. They've obviously dialed up those tariffs in the current administration from the previous one. They can allow these cheap goods to come through, which they won't, and that would be CPI will fall very quickly. But in the main, China's just got a different playbook at the moment to where we were 3 years ago, and the middle class of China are going to pay that price. Look, it is a property construction collapse like we've never seen. It will take a decade to get out of that. But again, in the main, China is just coordinating that middle class, go through the pain, hold on to that pain. Aggregate data will get us over the edge, and they are producing some key goods, particularly in the technology sector, in the energy transition sector, that the rest of the world needs at a lower price. And that's the nuance of it all. How do they do it? And we believe the risks are, which you can't price in with geopolitical, is that there's tariffs go even off the current template, which is really high. Tariffs just accelerate in 2025 to another level. They're the risks for the global economy.
George, before I let you go, I have to get your take on Japan. We heard from Governor Ueda speaking with Asahi Shimbun, saying that really greater certainty is necessary on the inflation story before there is any more policy action in terms of raising interest rates. Where are you on Japan right now?
Firstly, Ueda has played it perfectly and engineered these nominal rates to zero very well, and it's obviously communicated in hindsight via local press in Japan, and that's been a good nuance, and he's targeted that March-April period, and it's panned out. I think they're right to reinforce that they've got to pass through more inflation, obviously the weakness of the yen, the issues for their corporate sector on that, and passing those through. Yes, the wage rise is already built in. I do think they've got, at this stage, the current policy mix is good. The overweight to Japan as a consequence is reasonable. You can overgeneralize that calendar 23 was a value play, calendar 24 is a growth play, a GARP play for earnings in Japan. Mm-hmm. And I do think sitting back and that language is giving is quite good. So very happy with Japan, more predictive than it's been for some time.
George, thank you so much. George Boubouras of K2 Asset Management joining us here on Daybreak Asia from Melbourne. Meredith Whitney is with us. She is the founder, also the CEO of the Meredith Whitney Advisory Group. Nice of you to stop by. Good to see you. Thank you so much. I hope you're doing well. It was kind of interesting, and I don't know whether you've had a chance to listen to some of our Fed coverage today. I know we had about a half dozen or so Fed speakers today. Neil Kashkari caught my attention. He was saying that, hey, maybe we don't get any rate cuts this year if inflation proves to be as stubborn as it may be and the American economy holds up as well as it seems to be. Maybe Kashkari is not going to be one of those that would advocate for a cut. What do you think about that?
I think it's hard to argue with the fact that overall signals in the U.S. economy continue to be very strong. So it's hard to imagine, and I came into this year not thinking there would be 6 rate cuts. 3 even seemed aggressive. I think 1 would be at best, maybe after the election. But the economy is still strong. Wages are going to, I think, remain strong. I think jobs are going to remain strong because we have a real labor shortage in the U.S. So that'll people don't want to hear that. People don't want to believe that. Everyone thought that the Fed was signaling things that they didn't really mean. And I think as the year progresses, they'll appreciate the fact that the Fed has been saying they're data dependent and the data is stronger than would allow them to cut.
That's an interesting point. Do you have a sense of why the Fed, why Powell and company back in, let's say, November, December period of last year were so optimistic that they could be maybe as aggressive as to cut 75 basis points? What did they see then? What did they understand about the trajectory that allowed them to say that?
It's hard to see because I look at things on a very bottoms-up basis, and I think that the Fed is looking at a lot of 20 or 30-year-old measures to value the economy. And what you know, statistically as well as anecdotally, is that we have real shortage of labor in healthcare and home care, healthcare aides. We have a chronic and I think a systemically dangerous shortage in basic trade. So these are steel workers, these are electricians, these are plumbers. From the steel workers' perspective, welders rather, from the welders' perspective, that's where I say it's an issue of national security. And so it's very hard to imagine that abates anytime soon. So you've seen layoffs, the most prolific in the tech sector that had overhired. And you see really basic no impact in the unemployment and in the jobs data with over 500,000 lost jobs in the tech industry. I would argue, and this, by the way, is federal, Fed data and census data and BLS data, is the fact that, since COVID, more college educated workers are working multiple jobs. Prior to COVID, 30% of folks working multiple jobs were college educated. Post-COVID, it's over 50. And I think that's probably understated because people working full-time, high-paid jobs are probably not going to admit in a survey that they're working multiple jobs. But this is why, I just think you've got to go below the surface. And there are a lot of very smart people at the Fed, but they're looking at traditional metrics, which I don't think apply today.
Can I ask why you were in Hong Kong? Are you speaking with clients? Are you kicking the tires on some opportunities there? Why are you in HK?
Oh, well, for starters, I love being in Hong Kong. I love my clients in Hong Kong, and I'm on a board in Hong Kong. And it's just, it's hyper speed in terms of learning and a very, very smart investor base. So I come here at least once a year. Obviously, during COVID, I missed a few years, but I've been a regular Hong Kong visitor. What
is the view on putting money to work in China right now? I mean, the consensus opinion is you want to avoid it at all cost right now. In one of our surveys, we spoke, I think, to 7 different financial firms in Shanghai. All but one said the economy is yet to bottom. We're looking for further weakness. Is that the sense that you're getting, that it will remain a weak outlook for the Chinese economy in 24?
It depends on who you ask. So there are perma-China bulls in Hong Kong, and in the U.S., China is a 4-letter word. So it's very difficult. You see a real disparity in valuations, right? Chinese stocks are incredibly cheap. U.S. stocks, a lot of U.S. stocks are arguably very expensive. So there's a point where global managers are going to be underweight China, and when is that point that they'll have to reallocate their portfolios? It's hard to argue that demographics aren't on anybody's side in China. So it's hard to argue that the real estate market is truly bottomed. It's hard to argue that unemployment is not a problem. So you're always going to make the most money when nobody wants to go into a market. I'm not an expert on China, but it still seems a little the valuation. If you're a classic Chinese investor, you're not going to be swayed by so much aversion to the Chinese market. But it's all a question of timing, and I'm not sure it's right.
Meredith, before I let you go, 20 seconds. The biggest surprise that you have had during your time in Hong Kong is what?
The fact that so many people think Trump's going to win the election here.
Interesting. And that certainly is going to factor into the equation, particularly during Janet Yellen's visit to Beijing, which is underway now, and whether or not leaders in China are going to be betting more and more that they're not going to have to deal with the Biden administration a year from now. Meredith, thank you so much. Always a pleasure. Meredith Whitney of the Meredith Whitney Advisory Group joining us from our studios in Hong Kong. Garfield Reynolds, Bloomberg's chief rates correspondent for Asia. He joins us from our studios in Sydney. Garfield, it's always a pleasure. Maybe we don't get a rate cut at all this year. What do you think of that?
Well, it certainly has to be a possibility, given the extremely strong start to the year we've had from the U.S. economy. And as he said, if that continues, well, then why would you cut rates? I mean, that's kind of one of the underlying questions around the globe, is that most economies are looking pretty strong, especially your job markets are just fine. Your unemployment levels are the kind of place where 5-10 years ago you would have been ecstatic about those, and you would certainly not be thinking you need to ease policy as a result. Inflation also remains elevated, even though it's come down from those extreme highs. So all of those reasons say you have to consider it as an option that rates don't come down. The caveat is that with inflation having come down as much as it has, what we now have are restrictive rates in real terms. The cash rate is well above the inflation rate.
You're right about that. But I think the Fed is looking at the labor market in particular, as well as inflation, yes. But the labor market may now be showing signs of a little bit of softening. Weekly jobless claims at their highest level since January, although our Michael McKee was saying it's not exceptionally high. And then I was struck by a survey from the National Federation of Independent Business. The firms they surveyed, only 11% of those firms intend to add workers in the next 3 months on a net basis. So it's possible that we're beginning to see maybe a peak in the level of employment. Now, a lot more is going to become clear tomorrow with the March jobs numbers in the U.S. We're expecting to see healthy gains in payrolls and maybe a little bit of moderation in wages. So would you think that it's fair that the Fed remains very much focused on what's happening, not only on the inflation story, but the labor market especially?
Well, I mean, those are its two basic mandates. And the other thing to factor in is Kashkari, who doesn't vote, is definitely hawkish. Powell has been far more consistent in saying they do expect to cut rates and they do expect to meet the 3 rate cuts that they're projected in the dot plots. And that makes sense from the point of view of, in March, they boosted their forecasts for economic growth, and yet they stuck with their rate cuts. So to some extent, the way the economy is traveling now is not hugely at variance with how the Fed was seeing things developing when they had their last meeting. So they're still thinking they're going to cut rates, given that if there's a downside surprise for jobs, that will bring rate cuts roaring back into play. Market will probably overshoot, but certainly the current pricing for June as a likely rate cut venue will firm right up and we'll get back to betting on 3 rate cuts this year. That's still the base case seen in the markets, but there's a small constituency looking for maybe only 2. Mm-hmm. But yeah, a weak payrolls print would put us back to 3.
Yeah, we had a lot of Fed speak today. I think a half dozen of Fed speakers, and one of them was Tom Barkman of the Richmond Fed. He was saying it's smart to take your time to get clarity about where inflation is before you cut rates. But if you look at the way the bond market behaved today, yields were actually down. Obviously, the equity market got hammered, and the dollar, I think, softened just a bit. These perhaps suggest that, to your point, that maybe things are on track for cuts because there will be on the horizon, and maybe in the near term, a softening in the American economy, and markets are beginning to kind of anticipate that.
Yeah, I think so. I think also, the overnight action very much smelled like investors repositioning into jobs to looking, okay, where have we gone maybe a bit too far considering where we think things are going to develop. Yields are up a lot still on the week. The 10-year yield hit 4.4% earlier on, which was a level we haven't seen since back in November. So that makes sense to pull back from that. And stocks as well. Stocks had been marching on pretty much unconcerned. They got a little bit of cause for concern with what's been going on in the Middle East and what that is the oil price. Also with people like Kashkari laying out the potential that an upside surprise on jobs could take some of those rate cuts off the table. Mm-hmm. So again, plenty of reason to get a little bit nervous that you've gone too far in the way that the market has been going and pull back a bit. So that's why you've got to pull back in yields and you've got to pull back in equity prices. So
before I let you go, let's talk a little bit about Japan, not only the Bank of Japan, but the yen. I mean, the yen had quite a bit of strength here in New York today. I think we were up about 0.3%, the biggest gain in nearly a month. Some of that probably has to do with the anticipation that at some point, had the yen remained weak, that the Ministry of Finance in Japan would have had no choice but to intervene. So maybe a little bit of haven buying as well as a result of the sell-off that we had in risk assets. And here's Governor Ueda saying that there's a lot more that's going to be required before there is another move up in the official policy rate in Japan. Make sense of all of that for me. How do you see the yen's performance right now vis-a-vis BOJ policy?
Well, the yen's going to remain under pressure as long as the BOJ is pushing back against the idea that it's in any rush to tighten policy now that it's gotten rid of negative rates. I do think there's been a little bit of exhaustion when it comes to yen bears. The yen tried 3 times to go past 152 per dollar, couldn't make it. So given the strong anticipation that if there was a move past 152, that would lead to intervention, then you'll certainly put intervention far more on the table than it has been. So the failure of the dollar to go past that meant a bit of exhaustion there. There's this difficulty that on the fundamentals, the yen probably should be weaker. Certainly plenty of people think it should be. However, it's facing this double danger of the Fed still says it wants to cut rates. So if it gets a reason to show that that's definitely on the table, that's going to support the yen. And even as the BOJ says it's in no rush to tighten, the Japanese government has made it pretty clear it's getting kind of antsy about seeing the yen this weak. So that's keeping the yen in a fairly narrow range. The moves overnight weren't that large. They were just unusual in the scope of where they went. But it becomes hard to see. You need a real shock to send the yen noticeably weaker from here. That means this is kind of an asymmetric risk. Like if you get a shock that could send the yen stronger, it could go a lot stronger rapidly. There's nothing really to stop it. Whereas if you get a shock that should send it higher, you have the potential for the Ministry of Finance to step in, with a range of tools all the way up to actual physical intervention. So the downside beckons for the dollar yen at the moment a little bit more strongly than the upside.
Garfield, it's always a pleasure. I know it's a busy day for you there in Sydney, but I appreciate you making time to chat with us. Garfield Reynolds, Bloomberg's chief rates correspondent for Asia. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.